Welcome back to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Huel and Scott Campbell, financial planners for the Lion Wealth.
Welcome in. Got the Easter long weekend coming up.
Yes, sir.
You know what that means. More mini eggs than usual.
More mini eggs.
There's never a bad time for mini eggs, but the intake increases a little bit over
Just
Easter.
going to ramp it up a little bit.
Of course.
Yeah.
Is that the same in your household?
Yeah. We don't have too many mini eggs most days, but Easter weekend, sure.
Okay.
Yeah.
I'll drop some by if you need it.
Yeah.
All right. Well, happy Easter to everyone. Got a fun topic lined up. What are we chatting about today, Chris?
Yeah. One of our favorites. Probably like this should be on the FAQs, like most frequently asked questions on the website.
Yeah.
Should I pay off my mortgage or invest?
Yep. We get that question a lot.
Yeah.
It's got to be up there in the top handful of personal finance questions asked to Google, or maybe nowadays into ChatGPT or what have you.
Yeah, for sure.
So we got to go through both sides of this question, right? Because our favorite answer, to really oversimplify, is it depends. Depends 100%. On your situation. And what we want to dive into today is the different sides of that response. Like there's the math, the spreadsheet side. Like if we want to optimize, here's the answer that we'd want to give you. But there's also the human behavior side and the emotional decisions around making such a big decision. I'm always a big fan of what Morgan Housel said. I feel like we bring up Morgan in way too many episodes, but good friend of the show.
Yeah.
He says paying off his mortgage was the worst financial decision he's ever made, but the best money decision he's ever made, which I think is interesting.
Very interesting. Yeah, he's a smart dude. And also not just like a book smart guy and like a number smart. He's intuitive and emotionally intelligent. And I think a lot of, he has a very high IQ and in many different facets of life. So for him to say that paying off his mortgage was the worst financial decision he ever made, yet he's almost saying like he would do it again if he could.
Yeah. It was the best money decision he ever made. Right. Made him feel good. Yeah.
It made him feel good. Yeah. It's so interesting. Can I have a daily rant here?
Yeah, of course.
I feel like
this is the stage for it.
Every time real estate gets brought up, I have to do my real estate rant.
Okay, please do.
So this is kind of unrelated, but it kind of is not, because real estate is so emotional in nature. We get so emotionally attached to our houses. They become part of our identity, our family values and dynamic, and the memories we make. Some of that is all good, all well and good. But my daily rant, I just want to remind our listeners that buying a primary residence is not an investment. You're buying a place to live, and it should not be looked at as an investment first. If you're buying it for that reason, like, I think you're missing the mark. If we're talking about secondary or like third properties that you're buying for the purpose of, real estate investing, and you've done the analysis and have a case study of like, here's the rents, here's the, all of the stuff. And you think you want to be a landlord and run some rental properties, and that can be beneficial. Sure. But when we're talking about primary residence, it's a place to live first. It's an investment later down the road if markets go up. But I don't know. I just had to get that off my chest.
I think it's a good reminder, Chris. I think it is. I think two of us make a decision on where we're going to live with that thing in the back of our mind, thinking that is going to be this amazing investment for us, which in reality, like the rates of return historically on real estate in Canada, like obviously without, you had to take into consideration that the numbers are very skewed in Toronto and Vancouver and markets like that. But generally across the country as a whole, it hasn't been the best investment in relation to other asset classes you consider. But not that we're going to dive into that today.
But I think that's often so skewed because of that emotional connection, and because we don't actually calculate the true rate of return when we look at real estate. We often forget all of the maintenance and repairs and costs that we put into it along that way of the ownership. And we're also significantly discounting the fact that we are leveraging, like taking a lot of risk by leveraging when we own real estate via a mortgage.
Yep. I was thinking that same thing as well. Yeah. People discount the fact that you're leveraging in some cases 5 to 1 or more.
Yeah. So it can be good. It can turn out to be a good investment, but let's just say for the purpose of this conversation, we're talking about we pay off our primary residence mortgage or invest.
Yeah. So we have to probably set the stage first of like, you're in a financial position where you have, let's assume, excess cash flow from your income, or you have the ability to maybe, if you're professionally incorporated and you have a corp and you have the option to maybe pay yourself more from your corporation, and you have the luxury of making a decision. Should I be taking my excess cash flow and diverting that towards paying down my mortgage more aggressively? Or should I be turning those dollars into more contributions into my investment accounts?
Yeah. Can I jump right to the punchline?
Yep.
On pure math, investing wins, looking at the last 20 years.
Yep.
So the last 20 years, let's assume you were able to achieve 7% investment return, which was highly likely over the last 20 years, highly achievable, versus mortgage. I think we had it at 5% for the math.
Yeah, that's right.
Which is about the historical average over the last 20 years. In that scenario, investing your extra $500 per month wins out by about almost $80,000 over that 20-year period.
Yeah.
But there's some very significant assumptions we have to acknowledge here. And I think the biggest assumptions on each side, so on the investing side, we're assuming that you're never panicking, never selling when markets go down, when headlines get scary, when Trump does whatever Trump does, etc. We're not trying to time the market. We're just owning the market and achieving our 7% return. That's probably the biggest risk and assumption on the invest side. And then the other thing we have to acknowledge is that paying down the mortgage is a guaranteed risk-free return.
Yep.
That 7% investment return is not a risk-free return. That there's
a long-term average.
Yeah, that's the long-term average, but there's significant risk being undertaken in order to achieve that long-term average. So for that reason in particular, paying off the mortgage, the guarantee can often feel like a much safer thing to do.
Especially where I think right away too is it also may have a factor on how much you're leveraged on your primary residence. Like if you put 5% down on your property and you have, with CMHC insurance and whatnot, like you might have very little equity in your property. Do you think there's a difference for people to make that decision where they're in that situation where they have, call it little to no equity, but they have the cash flow to maybe pay that down more aggressively than their amortized schedule or invest, versus someone who says, you know what, I have paid my mortgage down for a period of time, or I was able to put down 20 or 30% or whatever the situation is, but I have more equity.
Yeah.
Do you think that decision's different?
I do. I think that without thinking of the math, just intuitively, and you did prep me for this, so kind of catch me off guard here, but I'll take it. I would think if you have 5% down and you're paying CMHC fees and, you've amortized, you've financed 95% of the house, so much of your regular monthly mortgage payment is going to be going towards interest and CMHC fees. But when you make an extra payment, that does go directly to principal. Yeah. So I think that it would intuitively feel more impactful at that for a mortgage of that type because you're actually making progress. Whereas when you just start out in a 25-year mortgage with 5% down, there's so little of your payment that's actually going towards equity.
Yeah, for sure. Yep. I know I feel different about the idea of paying down, thinking myself personally. I have a decent amount of equity in my house. I'm personally not in a rush to pay down my mortgage more aggressively than the amortized schedule, but it's because I've built up some decent equity. I've been living in this house for over a decade now, and the equity is built. The value has increased. So I feel more comfortable not rushing the idea of paying down my mortgage. But if I was on the flip side of that, where I was in a situation where I'd only put down 5%, but then I had this really large increase in income and I have the surplus cash flow to now make a decision, I probably would feel differently. I want to maybe get a little bit more equity build up in my home, my principal residence, before allocating those dollars towards further investing. That's just me though. And again, it comes down to personal preference.
Personal preference for sure. That's interesting you say that because I feel a similar way, but I think it's for different reasons. I feel good about not paying off my mortgage on my principal residence because I have built significant investment assets, and watching those grow has given me more confidence. And what you love to say lately, I've been noticing, you always say this phrase, we want flexibility and options. What can we do to increase your flexibility and options? And in my mind, having a pile of cash invested in various investment accounts gives me a lot more flexibility and options than having no mortgage.
That's right. Yeah. Because theoretically, like, yeah, you could take out a HELOC on your house and like take on more debt if you need it as you pay down your debt. But as you build up your investments, maybe it's a bit different if it's locked into RSPs. But if it's in a tax-free savings account or a non-registered or sitting inside a corporate account in your building, you have that option really at any time to make a decision to take a chunk of that and pay down some or all of your debt if need be.
Right.
Right.
Yeah, exactly. Especially when we get to like the lump sum options of like, hey, say we had a good year, we took a bonus out of the corp, extra 20K net after we set aside our tax money from that
Yeah.
dividend draw, or salary draw, whatever we classified it as.
Hmm.
Um, the impact of putting that in, say, a TFSA or even a non-reg for that matter, versus paying down the mortgage. It's like you have options when you invested in the TFSA or non-reg. You can at any time take that out and put it on the mortgage. But once it's on the mortgage, your options are limited. The only
Uh-huh.
way to access that money again is to go through a refinance, or if you have a HELOC attached to your mortgage, like a all-in-one.
Yeah, for sure. For sure.
So flexibility and options.
Flexibility and options. Yeah. And I think the other thing that comes to mind when it comes to paying down your debt versus investing, like when it comes to the emotional side of it, is kind of referred to as like loss aversion. I think
Mhm.
for some, the pain of, say, a significant market decrease of, say, 30 or 40% in their portfolio is going to hurt what the statistics say about 2 times worse than the equivalent gains that feel good when the market goes up.
Yeah.
Right. So for some, depending on how they emotionally and behaviorally react when markets go down or up, could play a factor of whether or not they should make that decision to throw some more money at paying down their mortgage.
Yeah, for
Right.
sure. It's a great point. And that's why we started with it depends.
Yeah.
It's like you have to know yourself. You have to know, like, behaviorally, how am I going to respond? What makes me feel better? And that's, I think, direct example of the Morgan Housel situation, why he chose to make a bad financial decision, which he calls a great money and probably life decision.
Hmm. Yep.
Yeah. Yeah.
For sure.
Can we dive into some numbers here? You did some great research here on like looking at some mortgage trends and investment return trends and stuff like that. And I think that's some important context to share. And we should probably back up that like figure we spouted off of, like, you'd be $78,000 or almost $80,000 ahead if
Yep.
you invested versus paid down the mortgage.
Yeah, why don't you hit on kind of historically what
Yeah.
maybe the spread or the differences have been over the decades? Because the time frame that you grow up and are an investor, like your journey is going to be different than your parents, right?
Right.
So that plays a factor in your decisions on how you feel about investing versus paying down your debt aggressively.
And I think that's a great example. If we look back at like the 1980s and 90s, when our parents were buying houses, there were mortgage rates in the 20% range at that point in Alberta. I'm
Yep.
sure it was similar across Canada, but 20% mortgage rate or 18, 19, whatever, like that was part of the range. Like in the 80s, mortgages ranged anywhere from 10% to 21.75%.
Yeah. Yeah.
That's crazy, right?
It's
So
pretty wild.
exactly. At the same time, if we look at the average mortgage rate, it was maybe 13.5%, while the average return of the Toronto Stock Exchange at that time was 12%. So
Yeah.
mortgage won by about 1.6% spread.
And one thing to add to that too, in terms of what was going on in the 80s that maybe is left out of the conversation about like high mortgage rates, would be that it was also different if you walked in the bank and got what's referred to as a GIC or guaranteed investment certificate. The rates on those were significantly higher as well. So it was also easier to park your money and get a guaranteed, maybe, I don't even know what GICs paid in the 80s, probably maybe not
Close
quite
to
as high as
mortgage
a
rates.
mortgage rate, but fairly high as well.
Pretty close, yeah.
Yeah.
Yeah. I don't know about you, but I have some family members that are big advocates of GICs and paying off mortgages. And I think it's recency bias. It's what worked for them. And I often hear what I'll blatantly call bad advice from
Mhm.
boomer parents. Let's pick
Uh-huh.
on our boomer parents for a minute, because that's what they grew up with and that's what they knew and what worked for them. But let's fast forward to the 2010s and 2020s. Well, the average 5-year fixed is now around that 5% rate,
Yeah.
so well under half of what it was in the 80s at 13.5%. just for some context here, if we look at the last 50 years, the average mortgage rate is around that 8 to 9% range. So again, another little mini rant here. I hate when people say mortgage rates are high, they're 5%, they're 4.5%. That's not high. Like in perspective, that's actually quite reasonable.
Yeah. Which makes
But
you
if
really
we're
think these rates that we saw in 2020, 2021, apparently 2026 is going to be the year of the most mortgage renewals in history across Canada. A lot of people renewing from 1.79 or 89 into now close to 5%.
Interesting.
Very interesting. Yep.
Okay, so through the 2010s, 2020s, let's just say average mortgage rate is in that 5 to 5.5% rate. If we look at investment returns over that time, very similar. We're looking at actually 7.5 to 8% return over the 2010s and 2020s. So investing is going to win here by 2.5% in both of those decades, basically.
Yeah.
So
you know what's interesting about that? Like the spread there is about 2.5%, like you say. But another interesting statistics that you can't ignore is that there was a study done by Dalbar who says there's what's referred to as the behavior gap, which we've discussed on previous episodes, is that the TSX, for example, over this time frame between 2010s and 2020 or 2020s has been somewhere between maybe 7.5%, 8% in that range. But that doesn't mean that's what the actual investor gets. Like the average investor is getting somewhere between 1, 2, maybe even 3% less than that on average because of what, Chris?
poor behavior.
Poor behavior, right? So now that spread becomes, very, very close in terms of the averages. Like that might be what the average TSX return has been, but the average across all investors has probably been actually a lot closer to the average mortgage interest rate over this period of time as well.
Yeah. Yep. That's a very fair point.
So
but our clients aren't average, Scott. They're above average.
I would agree in the sense that when it comes, I'll agree with you for sure. But when
you should agree, Scott. You should agree. They could be listening.
When it comes to, shout out to clients. You guys are all above average. When it comes to working with a good financial planner, but I'll just say someone who's in your corner that's kind of between you and making a poor investment decision, ideally that lowers the probability of you having that average investor return of 2% less than what the market's returning. So if we can coach our clients and those who are listening to say, like, if you have someone in your corner that can help you avoid those costly behavioral mistakes, then maybe it does make sense to say, I can handle a 30% down. I know it's going to come. It's not a matter of if, but when. And when that time comes, I'm going to see that as an opportunity. I'm going to continue to stay invested and receive that long-term average of 7 or 8%. That's going to be higher than my average mortgage interest rate.
Yeah.
And that's where you get that $80,000 gap that you're referring to earlier over a 20-year period.
Yeah. I love how you point out the 30% declines because we did see that in the 2010s and 2020s. Yep. And so if you stayed invested, stayed committed to the portfolio that you had constructed, because it was well suited to withstand those declines, you would have seen those 7.5%, 8% returns. But if you reacted, got nervous, changed your portfolio, sold when things were scary, you obviously would not have seen that. And that's exactly that behavior gap that you're talking about, right?
Mm-hmm.
Yep. Yeah. So let's finish the train of thought here on the math. Okay. So we got $500 extra per month. If we, in either case, this is going to equate to $120,000 over a 20-year period of time. Okay. If we put that on the mortgage at 5% interest rate, you're going to save about $62,000 in mortgage interest. If we put that $120,000 into the market at 7%, you're going to gain $140,000.
A lot more volatile, though.
It's a lot more volatile.
Yeah.
Yeah. The mortgage free date, obviously, we're not getting any further ahead if we don't prepay them or pay down the mortgage additionally. If we did the extra $500 a month, that might make us about 5 years roughly sooner. So yeah, again, back to what we said earlier, the paying down the mortgage, it's a guaranteed outcome. It's a risk-free return to pay off that debt. Investing, no guarantees. Market dependent. Markets will fluctuate. They will get scary, but you can do it with our help.
Chris, when do you encourage clients or when do you encourage people to say, yep, you should be paying off your mortgage more aggressively than the amortized schedule and we'll do a little bit less to investing, and we're just going to smash down that mortgage as fast as possible. When do you give the thumbs up on that idea?
Yeah. Well, first I'd say if it's a very risk averse client, then we
Yeah,
should,
that's number
meet
one.
them where they're at. That's the first one. So
For sure.
yeah, secondary, if they have significant financial assets and are tracking well for their intended goals, then and could scale back without impacting achieving those goals, then yeah, that's a great time to pay down the mortgage.
That's what I was hoping you'd say. If
Yeah.
they're on track to reach their goals long term, they're going to have the retirement they're looking to have, and they're trending in the right direction. Even if they don't optimize mathematically towards investing, and they defer to paying off their mortgage more aggressively, and they're going to reach their goals, then yeah, great, no problem. Let's support you. But
Yeah.
there needs to be a discussion where it's like, if you just focus on paying down your mortgage, you don't have any other liquidity or cash or other financial assets to access if need be, and you won't reach your financial goals, then that's where it's like, this decision may not be optimal because it's not going to lead you to where you ultimately want to go long term.
Yeah.
No
Exactly.
flexibility and options.
Flexibility and options. We keep coming back to it.
Oh, where would you leave listeners in terms of, like, maybe if we were to oversimplify, what should they consider from a few different perspectives before making an ultimate decision on, do you pay down your mortgage or do you invest?
Yeah. Yeah. I think we have to acknowledge that the best decision in this case is not, and in a lot of cases, is not always the one that's optimal from a mathematical standpoint. So we have to acknowledge and accept that it's okay if you want to do something that's suboptimal from a numbers standpoint, if it makes you feel a certain way and allows you to live a better life. I think that's probably the huge one. And then acknowledge our normal human biases and behaviors, and try to acknowledge and understand them and use them to help us make a better decision. If we know we're not going to be able to stick to that investing plan, or it's something that we can deviate from too easily, maybe it does make more sense to pay down the mortgage and do an extra payment. Yeah, I think ultimately it just comes down to taking the time that it deserves to clearly think it through, reflect on it. Like, it's not a decision that I think we ever encourage anyone to make in a quick manner. You can always change and adjust your additional mortgage payments, or if you increase your payment, there's like all of these most mortgage companies have very, plethora of options that you can consider, and you can activate those anytime. So take the time, think it through, talk it through with multiple people, with your partner, obviously, with your financial planners, obviously, with your mortgage broker. Take the time.
Something that we haven't really touched on too, when you say, discuss this and like analyze this in particular with your planner, is like, there's also some tax implications that we're not considering too, or that we should consider when making this decision, in terms of, are you investing into tax deferred accounts like your RSP?
Right.
Does it make more sense to invest that money and fully maximize your TFSA because of its upsides of growing your investments tax free?
Yep.
Right. One thing to mention too, that individuals, listeners out there might be seeing content on social media, and it might be from the States, where in the United States, the interest that you pay on your mortgage is tax deductible, where that's not the case here in Canada. Yeah. So a different consideration there as well.
Yeah, for sure. Yeah, you're 100% right on the tax advantaged accounts. That's a whole different analysis. If your TFSA RSPs for both you and your partner are fully maximized, and your extra investing dollars would be going into a non-registered or taxable investment account, that certainly adds a different component to the consideration, the analysis.
Yep, for sure. I would say for most people, if their tax advantage accounts, their tax-free savings account, their RSP, if those are both fully maxed out for both partners, they're probably on a good path towards reaching their long-term financial goals. So at that point, it just feels good to get that debt paid down more aggressively, so they can say, hey, we're debt free. Like, we own our house free and clear. That feels good. All the power to you. That's great.
Yep, for sure. Yep.
Cool. Any closing thoughts here, Chris, before we wrap it up?
Only other thing I would add is, like, you can do both too. Like,
there you go. Yep.
It doesn't have to be one or the other. You could, a hybrid approach, what if you increase your mortgage payment by $200 a month and put an extra $300 into investing? Like,
yeah,
you can do both.
Or you make steady RSP contributions throughout the year, and you make a decision to say, when I get my refund each year, I'm going to take that lump sum refund and I'm going to apply that towards my mortgage. Right. Lots of different ways you can approach it.
Totally. So much we could say, but I think we We did a good job I hope we did a good job going through it at a high level.
Our listeners can be the judge of that, Chris.
Yeah. Judge us, listeners, judge us.
Speaking of judging us, if you've been a listener and you've been enjoying the show, thank you for listening along. We could certainly appreciate a rating or review on Spotify, Apple, as well as YouTube to help support the show, get us out to more listeners.
Sounds good, Scott.
All right. Well, thanks for the chat, Chris. We'll leave it there.
Yep.
We'll see you guys again next week. All opinions expressed on the Cairo Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.